Good morning, friends, and welcome to the Trade Speakeasy. So one of the big things that a lot of my students are asking me or colleagues are asking me is, how am I interpreting the latest kind of bull movement that we've had running up into quad witching? And one of the things that I think is really important is that obviously we have to accept the fact that we had a very strong bearish trend during the first quarter, and then now into the last week's quad witching, we had this significant bull run, and it was quite parabolic. So that move doesn't seem to be very sustainable, number one. And number two, it seemed that we were just like sprinting towards a very strong resistance on the charts. But something that I think is really important is that even though you want to be analyzing your individual charts, you want to really consider what's happening at a macro level. And one of the things that we have to accept is that the Fed has already committed to rate hikes over the coming year. And we're looking at about 7 rate hikes. So I found this chart really helpful. And it's from All Star Charts. And they got this from Ned Davis Research. So I want to give them credit. But I really like how they have laid this out. Basically, they say there are historically 3 ways that the Fed deals with rate hikes. First, they can do it once, and then they let the market absorb that, and then they don't have to increase rates again. And that's the non-cycles, and that is that darkest blue line. And then you have the gradual cycles, which is where the Fed will increase rates, will have a rate hike once, wait a year, and then see how the market has interpreted it and what has happened with inflation rates. Well, that's not the situation that we are in. We're actually in this accelerated cycle situation where the Fed has already committed to 7 rate hikes. So as you can see here on the chart, when that has happened historically, the S&P will tend to have a sideways choppy market. Now, does this mean that we're automatically going into a recession, that we are going to have bear markets? No. But what it does mean is that because the S&P is a composite index, that there are underlyings in the S&P that tend to perform well in high inflationary environments and when the Fed is increasing rates, while others are not. And so now is a really good time to brush up on your skills regarding sectoral analysis, because what you do want to find is those corners of the market that tend to do well in these kinds of situations and those that do not. And that's actually how we end up with these like choppy charts. Something that I find personally very helpful when trying to look for breadth and participation is looking at this average. Let me just get it up on here. So this is basically looking at all the underlyings of the S&P and then seeing which of them are trading above their 50-day moving average and which is trading above, how many are trading above their 100 daily moving average and their 200 daily moving average. And basically that just shows you over a longer period to mid-term period to shorter period is how many underlyings are accelerating to the upside and how many of them are accelerating to the downside. And normally we should not have, normally what we would see is a bit of difference when we're accelerating to the upside, that we would see a bit of a separation in the numbers. And right now we're just getting, whoops. So this should be the 50. And so what we see right now is basically all of these we're seeing that across the board, we're somewhere between 40 and 52%. So basically half of the S&P is trading below all of their averages, the 50, the 100 and 200 daily moving average. So we need to see that start to accelerate to the upside. We need to see those percentages increase. And especially on the 200 or the 50, sorry, on the 50 daily moving average, because basically that will mean that on a shorter time frame, we are looking at fewer days, that we are seeing more bullishness than bearishness. And so that will help us have a stronger impression that the trend is reversing to the upside. And right now we're just basically seeing 50-50, which is much more like indecision in the markets. So again, this tells you that, okay, not all of the underlyings of the S&P are performing poorly, but you really need to find out which sectors are performing the best. And then if you are more comfortable with bullish strategies, or if you are looking at long-term buy and hold or longer buy and hold, in the sense that you're looking at 9-month or 1-year strategies, then you want to find the corners of the market that are doing their best and where there is strong participation in the sector, because in this kind of heavy market, you're probably not going to have individual stocks pulling ahead and then pulling the rest of the sector up. You're more likely to find that one sector of the economy is doing really well, and then there might be an outperformer on the bullish side, but generally that sector is doing well. So you might want to start doing analysis on what companies are interesting to you in those more conservative, risk-off value areas of the market as for the next 2 years, because it is likely that we will see a lot of choppiness, but there will be those outperforming sectors. So I really do hope that this helped. I know that I have referenced those, the $ SPX, A, 50, 100, 200R previously, but this is the first time that I have referenced this chart, and I found it extremely helpful for my own personal analysis and how I am reallocating my personal investments. So thank you for your time, and I hope you guys have a wonderful trading day. Bye for now.